and welcome to the Tax Roundup for January, and Happy New Year. First up, we're going to take a look at the latest guidance from the ATO. This is the final guidance on the profits of professional services firms. Now, this new guidance is set to commence on 1 July 2022. We'll also look at a new fact sheet that's been released on the tax treatment of transfers from foreign superannuation funds. And then finally, we'll look at the ATO's decision impact statement on the Addy case. Now, this is the backpacker case. We'll look at what the ATO has to say and the implications to clients more broadly who might be impacted. But first up, across to Michael on the profits of professional services firms. Across to you, Michael.
For many tax practitioners and clients who are involved in professional services firms, the most important or relevant update that we've seen over the last couple of months is the final guidelines from the ATO on the allocation of profits from professional services firms. Many of you would have been aware that this has been an ATO focus area for a number of years now, and we've been waiting quite a while for a final version of updated ATO guidelines in this space to give us some certainty on how we're going to move forward in this area over the next few years or so. Well, we now have the final guidelines, and whether you like what's in them or not, at least we have some certainty on how the ATO is likely to approach this area, and final version of, say, benchmarks that we will apply in determining risk ratings. Now, just by way of background, this whole area stems from the ATO's concern that business structures are being used in the context of professional services firms to sometimes enable principal practitioners to pay less tax than what the ATO believes is really reasonable or acceptable. So the ATO accepts that profits from a professional services firm could potentially flow tax effectively to certain related parties, for example, but the ATO believes that there's a limit on the extent to which you can do that without moving into anti-avoidance type territory. And so the point of these guidelines is determining risk rating. What level of compliance resources are the ATO likely to apply to your particular situation? And that will be determined by the risk score that you come up with under these guidelines. Now, the first thing we need to do before we actually get stuck into these guidelines is determine the type of income that is generated by the business. If your business generates income from personal services, so from the personal services of one or maybe more individuals, you don't apply these guidelines. In that case, you need to work through the PSI tests as a starting point. If the PSI tests are satisfied, there is a separate and very strict set of guidelines from the ATO on what you do with the profits generated from that business. Now, on the other hand, we'd be looking at situations where a professional services firm is generating income from a business structure. So from its employees, from its goodwill, that sort of thing. And that's the type of business that these guidelines are aimed at. So once we've worked our way through that threshold question of what type of income are we generating, we then work our way through the guidelines. Now, as I said earlier, the whole point of the guidelines is to determine a risk rating or risk level for individual principal practitioners of a professional services firm. And the way the ATO approaches that is to first look at whether the individual practitioner can pass two gateway tests. The first gateway test looks at whether there's a commercial rationale for the business structure and for the way in which profits are distributed out of the business. The second gateway test looks at whether there are any high-risk features that are present, and the ATO gives some examples of the types of things that it would consider to be high risk. Now, if either of those gateway tests are failed, you can't self-assess your position under the risk scores and risk rating approach that the ATO sets out. In that case, you are almost deemed to be a high-risk taxpayer, and the ATO is encouraging those people to engage with the ATO to kind of find a way forward. Now, where we can satisfy those two gateway tests, the next step is actually then generating a risk score, which then gives you a risk level and will let you know, really, the ATO approach from a risk point of view. The way these guidelines work is that there are three benchmarks or risk factors, and it's a matter of working through each of those to determine a score for each factor. We add that up, and that will give us our risk rating. Now, some of you might have seen the old guidelines in this area, and the approach here is a bit different. Under the old guidelines, it was really just a pass or fail. As long as you could pass one of the benchmarks or tests, then you would be considered low risk. These guidelines don't work like that. They require you to determine a score for at least 2 of the 3 factors, and sometimes 3 of them, and add that up to give you your risk rating. It's not simply just a pass or fail situation. So once we've worked our way through those benchmarks, we determine the risk score or rating, and that will tell us where we stand from a risk point of view with the ATO in this area. Now, one of the things that's quite important to point out is the timing of the application of these guidelines has changed a little bit from when the draft version was released. In the draft version, the ATO indicated that the guidelines would be applicable from the year commencing 1 July 2021. But the new and final version of the guidelines gives us an extra year before they really kick in and become effective. So the final version of the guidelines, the ATO says, won't apply until 1 July 2022, so the 2023 year for most people. In addition to that, there are some transitional measures that the ATO is adopting here. First one is for those people with pre-existing arrangements, they can continue to use the old version of the ATO's suspended guidelines up to and including the 2022 income year. In addition to that, for people who are classified as low risk under the old suspended guidelines, but would be in a medium or high risk category under the new guidelines, the ATO is allowing a further transitional period, basically to continue using those old guidelines and allowing those people some time to move into a lower risk rating, if that's what they're after. So there is a little bit of flexibility in terms of that start date. It's not quite always going to be 1 July 2022. For some people, there'll be a little bit of extra time to start moving towards a low risk rating under these new guidelines. So really important guidelines for anyone involved in professional services firms as an equity holder, directly or indirectly, and really important to start to understand what those risk ratings might be, even though the guidelines haven't actually started yet. Now's the time to identify what risk rating are we likely to be at. Now, if you've got clients who are looking at a high level like they would not be at the low risk level, but they want to be, well, that gives you some time to start talking to them in terms of, well, what steps would need to be taken in order to get that score down enough so that you'd be in that low risk level. So there's a bit of work to do, some conversations to be had, both internally within accounting practices, but also with clients who are involved in professional services firms. But as I said, at least we do have the final guidelines now. We have some certainty around this area in terms of what those benchmarks are, how we calculate those scores, and we can start to move forward. Now, for those of you who are Knowledge Shop members, we're working on some tools that could be useful for you in terms of working through that process and calculating the score. And our upcoming PD series, we will explore this in a little bit more detail, and we'll follow that up later with some more in-depth and technical webinar material on this as well, given that it is likely to have a pretty significant impact on a lot of people. So watch out for that. There's more coming, but at this stage, those final guidelines are there, and hopefully now we've got that certainty that a lot of us have been wanting in terms of how we approach this.
Now across to Matthew on the tax treatment of transfers from foreign superannuation funds.
Now, the ATO has published a fact sheet on the tax implications of transfers from a foreign superannuation fund. It does warrant some comments because this area can get quite complex quite quickly, and the fact sheet doesn't necessarily look at the complexity. Also, if the funds have been ticking along quite nicely for some time, you can sometimes end up dealing with some fairly large numbers. So if the client transfers a lump sum from a foreign superannuation fund to themselves personally as an Australian non-temporary resident, or sometimes to their Australian superannuation fund, then there are some concessional tax rules which can apply. The underlying idea behind these concessional rules is the client should really only be taxed on the lump sum payment based on earnings which have accrued or really been generated since the client became an Australian resident. Now, without going into detail, the key exception here is if the lump sum payment is received within 6 months of the client becoming an Australian resident. In that case, the lump sum transfer from the foreign superannuation fund could just be tax-free. That all sounds relatively straightforward, but the reality is that it's much more complex than that. The key challenge here is that the concessional rules should really only apply to funds that qualify as foreign superannuation funds. Now, the courts and the ATO have looked at this issue before, And basically, the key hurdle that tends to create a problem is where there's an ability or some flexibility for someone to make withdrawals from the fund for pre-retirement or really non-retirement purposes. In that case, the fund may not qualify as a superannuation fund, which are really funds that are intended to provide for retirement. Now, trying to work through all this in the context of a foreign regime just doesn't help and really adds to all the complexity. But if the fund isn't a foreign superannuation fund, you might just be dealing with a foreign trust. In that case, the usual rules around taxing foreign trusts should apply. Whilst these rules aren't necessarily straightforward either, the end result is that you normally end up with a harsher tax outcome. Otherwise, you might be dealing with a life insurance or a life assurance policy linked to some sort of investment or savings product, which has its own concessional rules. Without going into detail, bonuses received after 10 years from the commencement of these policies are generally tax-free. When the life insurance policy is paid out or surrendered, there's also a particular CGT exemption which can apply. What I'm really trying to say is that before you start diving in and advising on the tax implications, you really need to look at what you're actually dealing with. Are you dealing with a foreign superannuation fund, a foreign trust, or even perhaps a life insurance investment style policy? Now, like I said, this can get fairly complex quite quickly, and we usually advise or recommend that this does get looked into in detail. And sometimes detailed advice or even a private ruling from the ATO can be a fairly good option.
Now, Michael's going to take you through that decision impact statement on the Addy case.
Some of you might recall that we mentioned not long ago the High Court decision in the Addy case, and that was looking at the validity of Australia's backpacker tax rules and rates. Now, the outcome of that case was the High Court found in favour of the taxpayer, and a fairly technical sort of approach that had to be taken here. And in the end, the taxpayer won because of a couple of things. First of all, they were a tax resident of Australia. We'll get back to that in just a minute. They were a national of the UK, which happens to have a double tax agreement with Australia, but not only has a double tax agreement, but that agreement has a non-discrimination article in it. And the combination of those factors basically led the High Court to conclude that the backpacker tax rates, so that flat rate of 15%, should not apply in this case, because that would leave this particular individual worse off than a regular Australian tax resident. So a win for the taxpayer, but the question then becomes, well, how many people are actually affected by this decision and what do they do about it? Well, the ATO has now released some guidance following on from the High Court decision, including a decision impact statement and some ATO web material on how we would deal with this from a practical perspective. At a high level, the ATO's comments suggest that they believe there will be very few people affected by this decision in practice. The reason for that primarily is, first of all, not every country has a double tax agreement with Australia. Secondly, of all the double tax agreements that Australia does have with other countries, only a handful of them have one of these non-discrimination articles. And thirdly, most backpackers who are here in Australia on a working holiday are probably not going to be treated as a resident of Australia. Now, the first couple of bits of that analysis are pretty straightforward, which shouldn't be too hard to figure out whether a client who's been here on a working holiday visa is a national of a country that has a double tax agreement with Australia and is one of the limited countries that has a non-discrimination article. There aren't many of them. The more difficult aspect in many cases will be determining tax residency status under the normal residency rules. Determining residency of someone can be a very complex process. So that is something that will need to be looked at quite carefully. Now, the ATO's view, as I indicated earlier, is that most backpackers will not be residents of Australia. They're here for a holiday, but their visa just gives them the scope to do a bit of work to kind of fund their holiday while they're here in Australia. And for most people, that sort of scenario will not give rise to Australian residency. But there will occasionally be cases, and the Addy case is an example of that, where the individual does become a resident of Australia for whatever reason, their intentions might change, their pattern of behaviour might be a little bit different to the normal, and it may well be that there is a stronger connection with Australia, and it might look like that person has established a home here in Australia, and they may well then be treated as an Australian resident. So thinking about clients who maybe have been subject to those working holiday maker tax rates, certainly important just to have a think about whether they maybe could be eligible for a tax refund as a result of this decision, but it's very important to understand that it will probably be a quite limited number of people who would be impacted in a practical way by this decision. The other thing to remember, which is quite important, is it can actually also work against the taxpayer. If someone is an Australian resident, then they potentially are then taxed on worldwide income. What we then need to do is look at whether they could be a temporary resident, and that's a separate analysis that needs to be done. Temporary residents don't tend to be taxed in Australia on foreign income, but whether someone's a temporary resident or not really depends on the situation. For example, do they have a spouse who's an Australian resident or citizen, etc.? If so, they're probably not a temporary resident, which means they could now have foreign income, which end up being taxed in Australia, and they could actually be worse off as a result of effectively that decision. So we need to be careful. We need to be looking at the big picture, but also need to be very careful around that residency issue. So that's where the ATO is at the moment. They don't believe they're going to get a huge rush of people applying for a refund under the backpacker tax rules because they just don't believe that there's that many backpackers who are residents of Australia. So something to look at, but be very careful. You will need pretty good evidence to convince the ATO that one of your clients who's here on a backpacker working holiday is actually a resident of Australia.
And that's the tax roundup for this month. It's going to be another big year in 2022. We've got the budget coming up in March. It's being brought forward. And of course, the election year this year as well. We look forward to keeping you up to date with all of those changes that come through that are relevant to practitioners and advisors. If your firm is not a member of Knowledge Shoppers yet, we'd love to show you what a difference we can make to your practice. Give the team a call on 1800 800 232 and we'll show you what we can do. Speak to you soon.